Hi everyone, Buyer's Agent Jay Pace here for Providence Property Group with a market update for the year that was 2025. So this is my first market update back. So happy new year. I hope everybody's had a fantastic celebration and doing everything, but now we're straight back into it. I wanted to get into some data. And this is the new year, and I always like to, reflect and see what kind of 2025 was to me. And when I started going through that, upon my return, I kind of noticed that my social media feeds and casual conversations included a very familiar sign of doomsday warning. So I started seeing stuff like this, like, the 2026 crash is coming, get set for a bumpy 2026, the stock market's going to crash. I saw gold and silver fell the other day. Lots of people just starting to freak out. And I've been a professional investment advisor for over 20 years. And over those years, the clickbait on the economy collapsing and getting more, it's getting more prominent, okay? It's getting more prominent. And I don't know if that's just because information is so much easily accessible now than what it was for me 20 years ago, but it definitely feels that way. So what I wanted to do is I wanted to show you a bit of data, okay? Over the last 30 years, we've experienced 17% interest rates in the 1990s, 12% unemployment in 1992, the tech bubble crash in 2000, the 2008 GFC, the Euro sovereign debt crisis in 2009, the Australian mining crash in 2014, the Banking Royal Commission in 2017, followed by the crescendo that was COVID-19, which happened in 2020. Okay, then, on top of that, we then looked at sprinkling on top the war on terror, Middle Eastern civil wars, Russia's invasion of the Ukraine, the great US divide and the rise of Trump and MAGA, and the effects of mass international migration. And then let's not forget Israel and Palestine just recently as well. So that's just some of the things that we've endured, by the way, over the years. Why am I bringing this up? Not to give you our highlights of all the terrible stuff humanity's done over the last few decades, but more importantly, to let you understand the resilience of humanity, and more importantly, the resilience of property. So what I've done here is I've actually taken the data from the past 30 years up to 2022, and this chart shows the Australian property market over that period of time and where it's brought us to today. Now, in this, you could also see different events, major events throughout the world, both foreign and domestic, showing you how that's kind of affected the market and what the market did during that time. Now, here's the sad reality for Australian first home buyers. The Australian dream is dead, okay? Unless you're one of the lucky people that are going to receive some of the $5 trillion worth of intergenerational wealth transfer that's going to happen within the next 2 decades, it's dead for a lot of people, okay? Housing affordability is at record lows, and with an overwhelming feeling of hopelessness, many people need an apocalypse to actually occur in order for them to afford property. And this is why you hear a lot of people talking about it, because they feel just so hopeless. But the irony of that situation is that when we actually experience a downturn, and we did in 2017, you will remember we had about a 13% drop after the Royal Commission happened, and we had a slight 4.5% to 6% drop during the first few months of COVID. The irony is that when these market corrections occur, those who have been complaining that the market is too strong and overpriced, and those that are praying for a correction, when those corrections occur, those people now are seized by fear, and they claim that the market needs to fall further before they'll actually even get in. And that actually results in no change, because I have been doing this for long enough that I have seen multiple clients over 2 decades now that were telling me I want to buy, and the market's gone up and down, up and down, up and down, and they've just never gotten into it. Because for some people, talking about buying makes a lot of sense, but pulling the trigger, it's just not in them. And it's okay if that is you. If that's you, make your peace with it and do something else. Absolutely. I can't imagine being on that train and not being able to get off. But it's just very interesting. There's no change in their circumstances. And like sands through the hourglass, so are the days of our lives. Now, Providence was established 20 years ago, and I'm really proud of that. It's our 20th birthday. if we allowed ourselves to be paralyzed with fear and doubt every time the newest boogeyman reared its ugly head, we would have missed out on literally millions and millions in profit for our clients over the last 2 decades. As professional buyer's agents, we study market cycles and timing. Understanding these patterns is the key to success. And I encourage you to either educate yourself or surround yourself with a team of experts who can help you navigate your investments. Because in any moment of decision, the best thing that you can do is the right thing, but the worst thing that you can do is nothing at all. Let's look at some more data here. Okay, so we're looking at buyers getting into the market. It's actually a little bit faster than what it was the year before. You'll remember last year I showed that it was taking about 44 weeks in 2024 for people to purchase property. In 2025, that sped up a little bit, and the Property Seeker report from realestate.com shows it's dropped down to 40 weeks, which is quite interesting. Now, one can speculate as to why. Maybe it's because people are getting more desperate and they're just realizing the market's moving too quickly, so they're jumping in there quicker. I'm not sure. It looks like now in Sydney or New South Wales, 35 weeks, it's actually down 5 weeks. 41 weeks in Victoria, now down 3 weeks. 46 weeks in Queensland, no change to what it was last year. So it actually is the longest it takes for any capital city for people to buy is Queensland. The state, but Brisbane more specifically, because that would be where the majority of transactions would be. 41 weeks, down 8 weeks from 2024 in Perth, and 35 weeks, down 16 weeks from 2024 as well in Adelaide. Really, really interesting stuff. As usual, regional, always a little bit higher, but it has come down 7 weeks from what it was last year as well. So let's have a look now at the Hedonic Home Value Index and the numbers for the month ending 31st of January 2026. Well, we can see there that the best performer was Perth, up 2%. Perth is still kind of blowing my mind. I really thought it would take a little bit more of a breather, but this thing has stamina. It's got legs. 2% last month. Then followed by Brisbane, up 1.6%, and my most unfavourite, Darwin, 1.5%. And again, if you watch my videos, you know why I really don't care about Darwin. 19.7% up, best performance over the last 12 months. Massive risk there. What are we doing, people? We're just buying there because we're liking the rental yield, the price points are low, but what's going to sustain that? And when you drop a stone into a bucket, you're going to see a much bigger splash than when you drop a stone into an ocean. And at the end of the day, Darwin is a bucket. It's so small, it doesn't have enough. But if you get a few people buying in there, the numbers are going to make it look like there's some massive changes happening. So I'm telling you, again, this is fool's gold. Stay away from Darwin. Stick to the major top capital cities. Sydney, Melbourne, Brisbane, Adelaide, Perth. That is where it's at. You don't need to touch the other ones. Combined Capitals now has a value for the median dwelling of over $1 million, $1,02,520, which is quite insane, actually. If we look at the performance over the last 5 years, we can see, again, still my dark horse here, Melbourne, up 14.9%, just under 15% for the last 5 years, compared to the combined capitals that did 42.8. I mean, really, like I've said many times, this is a time machine. You are buying property in Melbourne using a time machine right now, and this is why I think it creates some attractive value. But again, when we were telling people to buy in Perth in 2020, it was a hard sell for us. People kept saying to us, it's never going to move, it's boom or bust. It hasn't moved since 2014. All it's done is gone down. But we had the data, we had the fundamentals. If you go back to our YouTube channel, you'll see us recommending it back in mid-2020, and you will see that the performance has been almost 90%. That's the average. If you're buying in above average suburbs, which we obviously plan to do for the next 20 years, our clients have definitely done above 100% during that time. So we've done very, very well, and we're very happy with that. Second place, Brisbane, very close to Perth actually, 87.2%. We got into Brisbane prior to getting into Perth. That performance has been really good as well. Adelaide, we didn't do as much in Adelaide as maybe I would have liked to, but still, again, we were able to distribute our wealth over Brisbane, Perth, Sydney, and Melbourne over the last 20 years quite significantly. So again, just looks like there's a lot of good opportunities there. I think Melbourne is definitely going to be the one to watch over the next few years. But don't sleep on Brisbane and Perth, because I still think there's good performance to be seen. Okay, as usual, I have done the numbers for the month for the speed check. In alphabetical order, we have Adelaide, $914,203 median dwelling value, up $89,000 for the last 52 weeks from the 31st of Jan 2024 to the 2025 to 2026. And then we've got a $1,700 per week increase. Brisbane, we've got a $3,000 increase. Melbourne, $900 increase. Perth, a $3,400 increase. And Sydney, a $1,600 per week increase. Again, that Melbourne increase, I know it's the lowest one out of all of them in regards to the per week increment, but every single month when I do these numbers, and if you go back in my videos, you'll see it's punching up over $100 and something every single month when I'm doing these videos. It is moving faster than all the other capital cities. It's just not there yet, but really, really interesting stuff. New data from, again, Property Seeker report shows 1.8 million sellers currently at the moment versus 4.1 million people looking to buy in Australia. Definitely a seller's market. Also, interestingly as well, 4 in 5 sellers are also buyers. That's 1.5 million of those 1.8 sellers are also looking to buy. Really interesting. And that's actually up 2 in 3 from 2024. Data here, despite healthy lifts in new listings, we can see here that the data is showing at the 5-year average, we're still 20.6% below the 5-year average, and we're currently about 16% below the same amount of stock that we had on the market this time last year. Why is this important? It's important because if you're looking for off markets or you're looking for unicorns with such little amounts of stock on the market, it just doesn't make sense to be that picky. You just need to get in and you need to move. We can actually break this down also via each individual capital city. So you can see here the ones that are even lower than the 15.8%, like Brisbane, 25% less stock than last year, and Perth, 34.8% less than last year. Just absolutely insane. Dwelling approvals. So reading through the noise, and we can certainly see a clear upswing in unit approvals is emerging. I've been talking about units now for about 2 years. As someone with a Greek and Maltese background, it's a cardinal sin to invest in units. But I am telling you, Australians have been brainwashed for a very long time, believing that units just don't make sense. And there are certain areas where the performance hasn't been there. But now that we're hitting an affordability crisis like we've never seen in our lives before, think about this. Where is the next generation going to live? Are they going to continue to buy further and further away from family, friends, and everything that they've known? Or are they going to start to compromise and buy units and focus on location? I can guarantee you, as the father of 2 young daughters, my children are not buying 2 hours away from me once they get to an age. They're going to be buying a unit so they live closer to me and my wife and our family. And I think that is a trend a lot of people are ignoring. I also think the trend of people coming from overseas, from countries where they're predominantly living in units and flats, is also going to have a huge change on the demand supply here in Australia. As usual, Australia's decade average for houses is still underperforming, 3.2% below that average, and I don't think that's going to change anytime soon. Let's look at rental yields. Across, we can see the combined capital is about 3.4% is the average rental income we're receiving at the moment. Sydney's still the lowest at 3%. A few little changes here. Melbourne's still sitting there at 3.6%. Brisbane's dropped down from 3.5 to 3.4, and Adelaide is at 3.5, with Perth at 3.8. Again, the star of the show is Darwin at 6%, which is another reason why so many people are looking to buy there. And with the first interest rate rise that we've seen happening this month, it was only just yesterday in February, I would dare say more and more people are going to start looking at places like Darwin just because of that rental yield. Is that the right thing to do? I wouldn't. Let's look at the cash flow example. So if you live in Australia and you're purchasing the median dwelling value, well, that's a house, townhouse unit, it's about $1 million, $1,02,520. And you're receiving the average rental income, which is about 3.4% of that value. You're receiving $34,085.68 for the year. Now, I'm not going to take into account things like holding costs like strata, insurance, maintenance, etc. The only thing I'm going to look at now in regards to outgoing cost is interest, the interest component that you're going to pay on that loan. Let's be conservative at 6%. 6% of the median dwelling value is $60,151.20. So I'm going to take my income of 34 grand minus my outgoing costs, about 60K, and that leaves me with a $26,065.52 deficit. So that's my holding cost for that asset. That's with a tenant, okay? That's with a tenant, and that's without any other costs. That means it's costing me about $501 per week. Now, a caveat here is that I've also assumed you have no deposit, that you're just putting in equity that you've taken from your current owner-occupier, or maybe your parents have given you equity or something like that that you've used. So obviously if you put an actual cash deposit in here, these numbers would change slightly, but I just want to make sure people understand the current position that most people are in, especially when people are looking for positively geared property. They don't really exist, and if they do, ask yourself, why is someone willing to pay a higher percentage to rent this property than they would if they owned the property themselves? Let's look at residential vacancy rates, still at record lows. As you can see, average 20-year national vacancy rate about 2.7%, and at the end of December, we're sitting at about 1.4. And there are plenty of major capitals and plenty of LGAs where the current vacancy rate is below 1%. Interest rate decision, the Reserve Bank of Australia, in all of its infinite wisdom, decided to increase the official cash rate by 25 basis points to 3.85. Inflation has eased from its peak in 2022. However, recent data shows a material pickup in the second half of 2025. While some of this increase may be temporary, the RBA has noted growing capacity pressures that suggest inflation remain elevated for some time. Now, it seems like that's the only gun these idiots can fire, and it definitely doesn't affect everyone equally, but that's just the way the cookie crumbles. Remember, we can survive this, people. We had 13 interest rate rises from May 2022 to our first interest rate break, which was in February last year. So we're going to be just fine. Now let's have a quick look at some recent purchases that we've done kind of at the end of last year. We were able in Sydney to secure this private 3-bedroom townhouse in a well-maintained and tightly held complex in the Sutherland Shire for our owner-occupier clients. The home is perfect for outdoor entertaining, high ceilings, tiled floors, street front position, plenty of natural light throughout. It complements the practical layout used in limited spaces that we can see typically in townhouses, and this makes a lot of sense. Townhouses are becoming more and more popular for people that are downgrading from large homes. They're an easy target, and for people that are upgrading from units, they're also an easy target. So they're getting the flow-on effect from both those groups at the moment. It's 18 kilometres south of Sydney CBD. We picked this up for $1,360,000. That's $770 per week expected in rent. Again, these are owner-occupiers, but I'm just giving you the understanding of the yield. That's a 2.9% rental yield. Why do we love it? The owner-occupiers, they needed assistance with their search for their kind of forever home, and the property exceeded the expectations. We were able to secure the property, and we got it under their budget as well. Now let's go to Melbourne, where a lot of business is going on for us there at the moment. Melbourne, we bought this house for an investor. The house was built in 2003. It sits on a large 500 square meter block in an established neighborhood. I love the big windows and the natural light. Always makes a house seem larger and more inviting. The bathrooms and the kitchen are a little dated, but they're still modern and usable. So we see a huge opportunity in a cosmetic renovation in the future as a great way to add value for the client. 36 kilometres southeast of Melbourne CBD. We purchased this for $845,000, $610 a week, or 3.75% gross rental yield. Why do we love this? Large internal floor space that has abundant natural light, including generous living spaces surrounding a central kitchen and a huge main bedroom. It's been recently painted, and the street that we actually bought in, this is a fun fact, it won Best Street Award in 2019 for that specific LGA. So that includes a double garage with internal entry and ducted heating and cooling. So again, we think this is a really good buy. Now to look at Perth. We got this set and forget investment property in North Perth. and it's got great internals, low maintenance. It's in a family-friendly area. It's 225 square meters with a rear lane access and double car space. So when we see stuff like this, again, it's very attractive and it's quite large. It just makes a lot of sense. So this is 6 kilometers northwest of Perth CBD. We got it for $950,000, $900 per week, or 4.9% rental yield. Still very strong rental yields in WA. Why do we love it? Again, low maintenance, rent-ready property, fantastic suburb. It's a modern townhouse. This is the last one I'll show you. This is in Brisbane. Our team did a really great job here. They picked up this 3-bedroom, 2-bath, 1-car townhouse in a boutique estate of terraces. It is positioned across a major Westfields shopping centre, and it's also got a large park on the other side of it. It's got nice high 2.7 metre ceilings, polished porcelain tiles with open plan living and dining area. It's a 3-story layout with a modern kitchen. It's actually really practical. I really like 3 stories. Fully fenced courtyard, minimal upkeep, 3 bedrooms with built-ins, main ensuite, the main bathroom with shower and bath plus powder room. The ground floor bedroom is really nice to have that kind of flexible living space with 1 bedroom on one level and 2 bedrooms on another level. Air conditioning, ceiling fans, security screens, lock-up garage, internal access and remote, plus visitor parking as well. It's a good property. It's easy. 8 kilometers from the CBD. I mean, honestly, $809,000 for a 3-bedroom property, less than 10 k's from the CBD in a great suburb. There's not a lot of capital cities you can get something like that. We're estimate for the rentals about $630 a week or 4% rental yield, which is actually quite decent. If the client has maybe a 20% deposit there, that thing's getting closer to about 5% rental yield. Why do we love this? Location, location, location. This is a low maintenance, set and forget investment with a lot of owner-occupier appeal. We just think it's great. Thank you so much. We can't help you until you commit, and once you commit, we won't let you fail. And we're bringing 2 things here. We're bringing together your desire to build wealth and our now 20 years of experience buying properties. And for more than 3 decades, Providence has helped Australians open a life of opportunity through real estate, giving them the future that they want. We buy unique quality assets in areas where demand outpaces supply, and we focus on properties that appeal to a much larger market of owner-occupiers. Technically, about 70% of purchasers are owner-occupier. We don't just want to focus on that 30% of people buying who are investors, and we buy in the right capital cities at the right time, guided by economic property cycles, and you would have seen lots of data about that in our videos. We buy the property which is uniquely suited to your situation, which will act as a springboard to your next wealth building stage. This is how top performing investors build wealth. So thank you so much for your time, and I will see you next month.